The world of finance moves at a dizzying pace. Trillions of dollars change hands daily. At the heart of this intricate system are banks. These institutions are the engines of commerce, the lifeblood of our global economy. They channel funds from savers to borrowers, facilitating investment and driving growth. Understanding banks is crucial to grasping the complexities of modern finance. Banks are more than just vaults for our savings. They are sophisticated institutions offering a vast array of financial products and services. From simple checking accounts to complex derivatives, banks cater to a diverse clientele, from individuals to multinational corporations. Their reach extends to every corner of the globe, influencing economic activity on a massive scale. The history of banking is long and intertwined with the evolution of money itself. From early forms of money lending in ancient civilizations to the sophisticated financial systems of today, banking has constantly adapted to meet the changing needs of society. As we move further into the 21st century, banks face new challenges and opportunities driven by technological advancements, globalization, and evolving regulatory landscapes. However, the core function of banks remains the same: to connect those with capital to those who need it. This fundamental role underscores the importance of understanding the complexities of banking in a world increasingly reliant on financial stability and sustainable growth. The banking sector encompasses a wide variety of institutions, each with its own specialized role. Commercial banks, the most recognizable type, serve individuals and businesses. They offer a range of services, including checking and savings accounts, loans, and credit cards. Investment banks cater to a different clientele, focusing on large corporations and governments. They underwrite securities, facilitate mergers and acquisitions, and provide advice on complex financial transactions. These institutions operate in the capital markets, connecting investors with businesses seeking capital. Central banks stand apart from commercial and investment banks. These institutions act as the financial backbone of a nation, controlling monetary policy and ensuring financial stability. They manage a country's currency, set interest rates, and act as a lender of last resort to commercial banks. The diversity of the banking sector reflects the complexity of modern finance. Each type of bank plays a crucial role in the smooth functioning of the global economy. Understanding these roles is essential for navigating the intricacies of the financial world. The banking landscape is in constant flux, shaped by mergers and acquisitions. These consolidations are driven by various factors, including the pursuit of economies of scale, increased market share, and access to new markets and technologies. In recent years, we have witnessed a wave of mergers and acquisitions reshaping the global banking industry. For example, the merger of BB&T and SunTrust in 2019 created Truist, one of the largest banks in the United States. This consolidation aimed to create a regional powerhouse better equipped to compete with larger national banks. Similarly, the acquisition of First Horizon by TD Bank Group in 2022 expanded the Canadian bank's footprint in the southeastern United States. Mergers and acquisitions can bring benefits such as increased efficiency and a wider range of products and services for customers. However, they also raise concerns about reduced competition and potential job losses. Regulators play a crucial role in scrutinizing these deals, ensuring they serve the best interests of consumers and the financial system as a whole. The rise of financial technology, or fintech, is transforming the banking industry at an unprecedented pace. Fintech companies leverage technology to offer innovative financial products and services, often at lower costs and with greater convenience than traditional banks. From mobile payments to peer-to-peer lending, fintech is disrupting traditional banking models. Companies like PayPal and Square have revolutionized online and mobile payments, while platforms like Lending Club and Prosper connect borrowers and lenders directly, bypassing traditional banks. Robo-advisors powered by algorithms provide automated investment advice, challenging the role of human financial advisors. The emergence of fintech presents both opportunities and challenges for traditional banks. On the one hand, banks can partner with fintech companies to enhance their offerings and improve customer experience. On the other hand, they face increasing competition from these agile and tech-savvy players. Adapting to the fintech revolution is crucial for banks to remain competitive in the digital age. Globalization has led to the rise of global banks with operations spanning continents. These institutions facilitate international trade and investment, providing a wide range of financial services to multinational corporations and governments. The growth of global banking has been fueled by technological advancements, deregulation, and the increasing interconnectedness of the global economy. However, the global reach of these institutions also poses challenges. The 2008 financial crisis highlighted the interconnectedness of the global financial system and the potential for shocks to spread rapidly across borders. Regulators face the complex task of coordinating oversight of global banks to mitigate systemic risks. The rise of global banking has also fueled debate about the influence of these institutions on the global economy. Critics argue that their size and power give them an unfair advantage and that they are too big to fail. Proponents counter that global banks play a vital role in facilitating global trade and investment, driving economic growth. The banking industry operates within a complex web of regulations designed to ensure financial stability and protect consumers. The 2008 financial crisis exposed weaknesses in the regulatory framework, leading to a wave of new rules and increased scrutiny of the banking sector. Banks must comply with a myriad of regulations covering capital adequacy, risk management, consumer protection, and anti-money laundering, among other areas. Navigating this complex regulatory landscape can be challenging and costly for banks. However, it is essential for maintaining public trust and ensuring the stability of the financial system. Banks that fail to comply with regulations face hefty fines and reputational damage. The regulatory landscape is constantly evolving, requiring banks to adapt and invest in compliance infrastructure. The challenge for regulators is to strike a balance between ensuring financial stability and fostering innovation. Excessive regulation can stifle growth and innovation, while lax regulation can increase systemic risk. Finding the right balance is crucial for a healthy and dynamic banking sector. The 2008 financial crisis eroded public trust in banks. The perception that banks had engaged in risky lending practices, fueled by greed and a lack of accountability, led to calls for greater transparency and accountability in the financial sector. Rebuilding public trust is crucial for the long-term health of the banking industry. Banks have taken steps to regain public trust by strengthening risk management practices, improving customer service, and increasing transparency. However, more needs to be done. Building a culture of ethical conduct and responsible lending is essential for restoring public confidence in the banking industry. Banks must also work to address the needs of underserved communities. Expanding access to financial services for low-income communities and small businesses is not only socially responsible, but also makes good business sense. By serving a wider customer base, banks can contribute to inclusive economic growth and strengthen their own long-term sustainability. Climate change and environmental degradation pose significant risks to the global economy. Banks are increasingly recognizing the importance of incorporating sustainability into their lending and investment decisions. By financing renewable energy projects, promoting energy efficiency, and supporting sustainable agriculture, banks can play a crucial role in transitioning to a low-carbon economy. Investors are also demanding that banks consider environmental, social, and governance (ESG) factors in their investment decisions. Banks that fail to address ESG risks may face reputational damage and lose investors. The integration of sustainability into banking practices is not only ethically sound, but also makes good business sense in the long run. Banks can also play a role in helping communities adapt to the impacts of climate change. Financing infrastructure projects that enhance resilience to extreme weather events and supporting communities most vulnerable to climate change are essential for building a more sustainable and equitable future.